All right, let's talk about something that quietly eats away at millions of investment portfolios every single year: capital gains taxes. You can think of it as a silent partner. The one you never actually agreed to have, but whose cut can seriously impact your financial future. So today, we're going to pull back the curtain and show you exactly how to minimize that partner's share and maximize yours. So let's start with this number, $6,000. What is that? Well, for a typical investor, someone with, say, $500,000 in a portfolio, this is roughly what you could be losing every year just from not managing your taxes well. That's 6 grand gone. That could have been working for you, compounding year after year. It's a massive, massive leak in your financial boat. You guessed it, it goes straight to that silent partner, the government, as capital gains tax. But here's the good news. This is not some fixed, unavoidable cost. Not at all. It's a number that you have a surprising amount of control over. And in this explainer, we are going to break down exactly how you can take that control back. Okay, so first things first, let's talk about what I call the invisible tax bite. Before you can manage your taxes, you've got to know what actually triggers the tax bill in the first place. And it really all boils down to one single action. This is such a critical distinction. You see, you could own a stock that's made you a millionaire on paper. But as long as you haven't sold it, you have what's called an unrealized gain. It's just a number on a screen. And you know what? The IRS doesn't care one bit. You owe absolutely zero tax on that. But the very second you hit that sell button, that paper profit becomes a realized gain. And that's when the tax clock officially starts ticking. And that's really the whole key right there. It's that simple. The act of selling for a profit is the trigger. Every single strategy, every smart move we're about to get into, it all revolves around how and when you decide to pull that trigger. And that brings us to what is, without a doubt, the single most important rule in this entire game. You have to understand the difference between short-term and long-term gains. Seriously, getting this one thing right can literally save you thousands of dollars. So, check this out. The tax system basically has two different paths. If you sell an investment you've held for 1 year or less, that's a short-term gain. It gets taxed at your normal income tax rate, which can be pretty steep, all the way up to 37%. But if you hold that exact same investment for just 1 day longer, more than a year, it magically becomes a long-term gain. And look at those tax rates. They plummet down to 0, 15, or 20%. The system is screaming at you, rewarding you for being patient. And this table just makes it crystal clear. This is a perfect example. You've got two investors, right? Both made the same $10,000 profit, but look at investor A. Sells after 360 days, gets hit with a short-term gain, and pays a painful $3,200 in tax. Now look at investor B. All they did was wait 6 more days. Just 6. That little bit of patience got them the long-term rate, and their tax bill was only $1,500. Same investment, same profit, completely different result. Let's just put a number on that. Waiting just 6 days cut the tax bill by more than half. That is a 53% tax reduction. For what? For doing nothing, just for understanding and respecting that 1-year line in the sand. That's the kind of power we're talking about here. Okay, so now that we've got the most important rule down, let's talk about strategy. I want you to think of these as two powerful levers you can pull to actively take control of your tax bill and keep more of your hard-earned money. Now, this is going to sound a little backward at first, but stick with me. In the weird world of taxes, your investment losses can actually be one of your most valuable assets. It's a strategy called tax loss harvesting, and it's all about reframing a losing investment, not as a mistake, but as a strategic opportunity. Here's how you do it in 3 super simple steps. First, you sell an investment that's in the red. This makes the loss real. Second, and this is the magic part, you use that loss to cancel out your gains. So if you have a $10,000 gain somewhere else, but you harvest a $10,000 loss, poof, your net taxable gain is now 0. And third, if your losses are bigger than your gains, you can even use up to 3 grand of what's left to lower your regular income tax bill. It's a way to find a silver lining in a losing position. All right, lever number 2 is all about asset location. Location, location, location. It's not just about what you own. It turns out where you own it can make a gigantic difference to your tax bill. And here is the absolute game changer. Get this. Inside your tax-sheltered retirement accounts, like a 401k or an IRA, you can buy and sell all day long, and you will never, ever get a capital gains tax bill. Think of these accounts as a kind of tax fortress, completely shielding your investments from all the tax drag we've been talking about. So the strategy here is pretty straightforward. In your normal taxable brokerage account, you want to hold your tax-efficient stuff, things you plan to buy and hold for a really long time, like index funds. Then you take all your tax-inefficient stuff, things that trade a lot or kick off a lot of income, and you stick them inside that retirement tax fortress. Inside there, they can trade all they want because they're protected. So as we start to bring this all home, it's important to realize that learning these rules and pulling these levers, it's not just about a few tricks. It's about making a fundamental shift in how you even think about your investment returns. We all get so excited when we see our portfolio is up 10% or 15%. But that's a pre-tax number. It's basically a vanity metric. If you have to turn around and hand a big chunk of that back in taxes, your real return is way lower. The only number that truly matters is your after-tax return. It's the only part you actually get to keep. And this chart just shows you the devastating impact over the long run. Let's say you start with $500,000. Over 20 years, it grows into a beautiful $3.35 million. Awesome, right? But wait, once you factor in a pretty normal tax drag, your actual take-home amount is only $2.15 million. That's more than $1 million that just vanished, paid out to your silent partner because taxes weren't managed along the way. And that's really the bottom line here. That silent partner is always going to be there, waiting for their share. But they don't have to take a huge bite. By being smart, holding for the long term, using your losses, putting things in the right accounts, you get to decide how much you're willing to share. You're in the driver's seat. So that's the final question I want to leave you with. Every decision you make, when you sell, where you invest, how long you wait, it's all an answer to this question. Are you actively building your own wealth, or are you just passively building your silent partners? The control is all yours.